Hello students. So let's start and revise the concepts of time value of money that you have done in the class. So first one, what happens if one deposits one lump sum amount for a period of 10 years at a rate of interest of 4%? And say for example, you have deposited a lump sum amount of 20,000. That is, you made this investment just once and forgot this money for 10 years, and you want to know that what is the amount you would get at the end of the investment period. So what is the future value formula you're going to use is future value is equal to present value into future value interest factor, that is 1 plus r raised to n. You put the values of present value of investment as 20,000, rate of interest as 4%, and number of years as 10 years. And you get the final amount as rupees 29,600. Now, say for example, government has increased the rate of interest, and what lump sum investment you made for 20,000, the rate of interest that you're going to earn on that is now 9%. What is the final amount you will receive at the end of the investment period is, again, one lump sum investment. So the formula would remain the same. Future value is equal to present value into future value interest factor, that is 1 plus r raised to n. The only difference in this question is that the rate of interest is changed from 4% to 9%. What happens to the amount? Check. The amount becomes 47,340. Now, another concept you would have learned in the classroom, present value of whatever is the lump sum amount that you should deposit today. If the rate of interest is 5% and you need rupees 25 lakhs to buy your business in 5 years. So what happens? You want to know that, okay, what is the investment that you should make today so that you get rupees 25 lakhs at the end of 5 years if the rate of interest you earn is 5%. So you need to find out the present value. So what's the formula? Present value is going to be equal to future value divided by 1 plus r raised to n. And since you want to find out the present value, you will look at present value interest factor table. That is for 5% for 5 years. So here you get what is the amount you need to invest today, that is 19,58,800, so that you get an amount of rupees 25 lakhs at the end of 5 years at a rate of interest of 5%. Now, to understand this present value and future value, the underlying concept is simple interest and compound interest. And what we use in the concepts of present value and future value is compound interest. That is, interest gets added on and the amount gets increased. Why? Can you look at the formula? It says future value is equal to present value multiplied by 1 plus r raised to n. And as the number of years are increasing, the compounding effect goes on increasing, and that increases your future value of investment. In case of simple interest, what happens? The compounding effect is not happening. That is, interest is not getting added to the interest. So what's happening is your future value is whatever principal you have invested plus just the principal multiplied by the rate of interest into number of years. And that's why when you see that if you have deposited 1,000 rupees at 12% for 5 years, the amount is 1,600 in the case of simple interest, because there is no compounding effect of interest on interest. Whereas in the case of compound interest, you see that the amount is 1,762. Why is that? The result is due to that the interest every year that you earn gets added on, and the next year you earn interest on the principal plus the interest that you have earned the last year. So it gets on accumulating, the compounding effect starts adding on, and that's why the result in compound interest is more as compared to the simple interest. And now you should understand the basic concept that in case if you want to earn more of interest, you would prefer a compound interest. So say for example, if you go for investment of a fixed deposit in a bank, you would prefer a compound rate of interest. But in case if you want to take a home loan or a personal loan, you would prefer simple interest, because in that scenario, the rate of interest that you pay is going to be less. In the sense, the EMI and everything that would be calculated would be comparatively less as compared to the compound interest. For more on time value of money, we'll meet again in the next session.